All right, this is Christian McFarland, and I am here with some of the agents on my team, specifically with, I don't need to name any names here, but with several agents who are on my team. This is going to be a presentation. This is not going to be a conversation, and it is garbage day in my neighborhood and the truck's leaving. Thank goodness. There we go. That should be the last of our background noise in my otherwise quiet mountain neighborhood. So this is Christian McFarland, CEO of Zero Limit Group, and we're going to talk today about some principles that I've been studying by a guy named Ray Dalio. And if anybody doesn't know who Ray Dalio is, he is the founder of Bridgewater Capital, and that happens to be the largest hedge fund on the planet. He is one of the top 10 wealthiest people in the world, and he knows a little bit about money and has some pretty good wisdom on that. So you can see his principles that I've already typed up here on the screen. Our first thing is we want to set ambitious goals. And when we set goals, it obviously doesn't always work out. That's because we can encounter obstacles. And so what we have to do is figure out what those obstacles are that are preventing our success, and then design solutions to the problem that can help us to overcome those obstacles, and then set new ambitious goals. So we're going to talk about several different things here. A couple of them I've already written down. There's risk, and I'm actually going to substitute in here. I forgot to put one in here. We're going to talk about fees. We're going to talk about taxes, and we are going to talk about that debt burden right there on several different levels. Now, the other thing that I want to throw in here is a fifth topic, which is government and political issues. And I'm not trying to take a stand on either side of the aisle here. I'm talking about fundamental government and political issues, such as those related to monetary policy, in other words, not fiscal policy. So there are some of these issues that we want to talk about as longer-term political issues, longer-term geopolitical economic cycles. And actually, if everybody wants to go ahead and mute for now, and we can unmute at the end and talk, just so there's no background noise, that'd be awesome. I'd appreciate that. And then the last thing we're going to talk about here is what I'm going to call the currency wars, and we're going to bill that as America Challenged. Because when I first talked about this, I was talking about the rise of China. And, China has been rising, but there are other countries like Vietnam, Mexico, and India that are poised to also be threatening America's currency system. All right. So moving into the first topic here, let me go ahead and bring out my PowerPoint. I am screen sharing, right? I'm sure I am. Somebody unmute if I'm not. But we're going to jump right over here to the wealth killers. And this is a slideshow that I put together that summarizes a few things that I learned. And this is going to talk about risk and taxes just a little bit. And we're also going to mix in fees here. So with risk, the key insight that we want to do is obviously get it out of our math. And where I learned this most convincingly quite a while back was from Tony Robbins in his book, Master the Game, Money, Master the Game. And in that book, much like Napoleon Hill did back with Think and Grow Rich, he went around and interviewed the most successful women and men who are money managers all over the world. And one of those people is John Bogle, who's the founder of Vanguard Mutual Funds. In fact, he is actually the inventor of the whole concept of a mutual fund. And to quote Mr. Bogle, indexing is the best investment option because it gives us diversification. Now, he's talking about indexed mutual funds. We have something that's even better than that called an indexed annuity or indexed life insurance. But what that product does is it removes risk from the table. And this complies with the rules that we learned from Warren Buffett. Number one, never lose money. Rule number two, never forget rule number one. It's kind of a comical way of saying it, but it's very memorable, and it's obviously very important. So when it comes to taxes, the question is whether we want to defer a tax. And I'm here to tell you guys, you're all my friends. Friends don't let friends defer a tax if there's any chance that the tax rate could go up in the future. So let me actually jump out of this for a second and open up a different resource here. And we're going to just grab a little tool I have here that shows the history of the tax rates. And in the orange box here, you can see that going back to 1913, when we established the current income tax rate, it was pretty low at first, and then it did go up in the period of World War I, and then it did drop during the period of what they call the golden age of America before the Great Depression. We had the stock market crash, and into World War II. The point I'm really making here is not to go through a review of American history, but look how low tax rates are currently relative to where they've been in the past. So if we look at another graph here, I don't need to tell anybody how large the US debt is, but let's just take a really quick look at it here. How big is it? First of all, how big is $1 trillion? People say $1 trillion, but what does that even really mean? Okay, so if we just I really hate ads. I need to get premium here. So if we just stack up $1 trillion here, I'm going to fast forward this just so we get the point. We're not going to spend 5 minutes watching this, but I think you guys are getting the impact here of what $1 looks like compared to $1 trillion. My guys, that's $1 trillion there. So when we understand what $1 trillion is, and when we start to look at what America's debt load is, and we look at our US debt clock, okay, I'm going to open up another link here for a second. This is the US debt clock. A lot of you have probably seen this before. It's going to take a second for that to load. This is live updating in front of your eyes, okay? You see our federal debt is completely off the hook. If anybody wants a copy of this, I can get it for you. So when we add those factors together and we look here at this green line is the same as the red line we were looking at over here. That's the marginal tax rate. Do you guys see how the marginal tax rate has conformed with the US debt load until the 1970s? When people talk about the system being rigged, this is the actual evidence that you might be looking for. I'm sure you can see the inversion of our debt ratio compared to the tax rate right now. What am I getting at? I think a lot of you have already read David McKnight's Power of Zero book. If the politicians don't fix Social Security and Medicare, people in the 34.9% tax rate are probably going to go up to 88%. Bringing this all back home, what we're talking about is friends don't let friends defer a tax when there's any chance that tax rates could go up in the future. I think I've just compellingly demonstrated how likely it is that tax rates will rise over the next 20 to 30 years, if not much sooner. Am I cheering for that? Are you kidding? Of course not. I mean, I'm in that 34.9% tax bracket. I don't want it to go up to 88%, but it's the reality we're dealing with. And the only way to fix it is for politicians to come together and fix Social Security and Medicare. And I don't know about anybody else, but that's not very likely. So to put this a little bit simpler, I ask people this all the time. Sometimes people get confused about tax deferred or tax free. Let's talk about cancer for a second. If you had a choice between being cancer deferred and cancer free, there's no choice. You'd choose cancer free. It's really no different when you understand the difference between tax deferred and tax free. And yet, most Americans are making the decision to defer their taxes. It's not a good idea. Robert Kiyosaki tried to teach us this in Rich Dad, Poor Dad. You guys all know this. It's not how much you make, it's how much you keep. You see, my friends, we don't have a choice about paying taxes, but we do have a choice about how much we'll pay in taxes and when we'll pay the taxes. Because why would we want to pay our taxes on the seed? Or we would want to pay our taxes on the seed. Why would we want to pay them on the harvest? If we have $10,000 and we hope it's going to grow to $100,000, which one do we want to pay the taxes on, especially if it's likely that tax rates will be higher in the future. So there is a secret sauce that the wealthy are using. There are two tax codes. There's one for people who don't mind paying unnecessary taxes. It's what I like to call hating your money. And there's another tax code for those who don't hate their money. So getting this back on, staying on track here, we've talked about risk, we've talked about taxes. Let's talk about fees for a second. Here's what Wall Street's going to want to say. Wall Street's going to want to say, oh, but life insurance and things like that are expensive when it comes to fees. When it comes to fees, what do we get? Now, when it comes to a broker, we get advice. And that advice is usually about deferring our taxes and putting our money at risk. So, if I was just going to ask a rhetorical question, what are we really getting than somebody's opinion about exposing our money to unnecessary taxation and risk when we're paying a broker? And the answer is not much. What's their track record? 4.02% is what the S&P 500 has returned over the last 20 years. Need proof of that? Okay, we have proof right here. Let's have a look. Oops, wrong folder. We just come back over here to the red line, blue line tab. Now, if we look at this right here, this red line is the actual returns of the S&P 500. You can see that quite visually. And if I come over here to one other chart, oops, this one I mean, and we're just going to fill this in, and you can see that the actual return of the market here has been 4.02% over the last 20 years for the stock market. Now, as long as we're on the spreadsheet here, let's look at this for a second. If we were to get an 8% return on our money, which is not very realistic, and pay zero fees, this is how much money would have to be putting away per month at age 50 to have a $5,000 income for 20 years starting at age 70. Now, since 8% isn't realistic and the actual stock market has done 4.02, when we're talking about paying fees to a stockbroker, the lowest advertised fees are Kingfisher at 1.25%. So there is no such thing as one. Most people are paying higher than 1.25. They're paying more like 2%. So an actual realistic return and fee picture would say that a 50-year-old would need to be putting aside $3,390 per month. The average American household income is just below that number. That's the number that they would need to be saving. To say that's not a realistic number is pretty obvious. People are not able to put aside enough money. Why? They have too much debt. Nobody can argue with that. We all know, we just looked at the debt calculator clock. So let's jump over here. We're jumping around for a couple of different resources here. This is all kind of intro and preview, and we can go back and get more detailed information on some of these things. And we don't have time for this whole presentation here, but I'm just going to grab one particular slide here, which shows basically how we get people out of debt. And this is essentially how it works for people who are eligible. And the reality is not everybody is eligible for this program, but people who have debt over about $20,000 and who are able to make their minimum payments on that debt are good candidates for this program. And what the system does is it works a lot like the Terminator in the Arnold Schwarzenegger movie, where it's like a detective, it's hunting and tracking. And if we have credit, I'm going to demonstrate that right now. If we don't have credit, we can also use a savings account method that's not quite as fast. But in the faster and preferred line of credit method, we're building up our income. Here comes our income. We just got paid, and we're using that money to pay down the line of credit. We now have more available line of credit. The whole game here is to figure out when we have enough available line of credit. You see that? When we get to that optimal transfer point, you see the lavender available line of credit, we can now use that. We're relying on the artificial intelligence and machine learning based on tens of thousands of algorithms and millions of lines of code that are intelligently deciding the exact mathematical point at which we should use our line of credit to A, minimize the amount of finance charges on the line of credit, and most importantly, to maximize the impact of interest cancellation on our closed-end loan. Now, when I talk about interest cancellation, most people already know about this, but just to very quickly touch on this, here's what we're talking about with interest cancellation. And with interest cancellation, if we pay a minimum payment of $11.99 and 10 cents, 1,000 of that has gone to interest. That's 83% of our first month's interest on a 6% note on a mortgage is going to interest. But if we were to at the same time send in $200.10, we would not owe the $999 interest coupon attached to that. In fact, if we took 10-10-54, we would be able to get a guaranteed 498% return on investment. That's officially a tease. To learn more about exactly how that works, get with anybody on this meeting or whoever sent you this video to book an appointment with me to learn more about how all this works. So all of these things are obstacles that we can run into to why we're not building up wealth. To review very, very briefly, we talked about risk, fees, taxes, and the debt burden. Now, if there are any financial professionals listening to this, just imagine for 1 second what you could do in your practice, whether you are a mortgage broker, whether you are a real estate agent, whether you are some type of insurance agent or other financial advisor. If you were able to free up $1,000, $2,000, $3,000, maybe even $4,000 in a household. I have cases on file with $3,000 and $4,000 that we've freed up in debt. What could you as an advisor do with that extra money in their household if they wanted to save money for their retirement and have a more dignified retirement? And the answer is quite a bit. So looking at the time here, we're looking like we're pretty good on time so far. And we do have time to get into some of the bonus content that I wanted to get into here. And that's my notification of my appointment coming up the top of the hour. But I did want to touch on some of the stuff that I've been learning about from Mr. Ray Dalio, the person I referenced at the beginning of this, the CIO and founder of Bridgewater Capital. So when we look at some of the governmental and political issues that we're facing right now, that is going to start with an understanding going back to something called Bretton Woods in 1945. And in that system, they set up our current monetary policy. And our monetary policy for a long time had to do with just lowering interest rates. And a lot of you know exactly what I'm talking about. We would get in a recession and they would lower interest rates, and that would stimulate the economy. And unfortunately, what's happened now is that our interest rate environment has gone down to basically a zero interest rate environment. In fact, in some countries, we even have negative interest rates. So that's called monetary policy number one. Now, since they can't lower the interest rates anymore, we're now going into what we call MP2. And we started to see MP2 back with what they called quantitative easing. If I can remember how to spell quantitative. And quantitative easing is a great big fancy word for talking about printing money, okay? And what they do when they print the money is they then buy financial assets, particularly US treasuries. In other words, they are financing and underwriting the government's fiscal debt with the monetary policy from the central bank, okay? That's monetary policy two. The situation we find ourselves in now is that the central bankers and the policymakers are not able to use either of these mechanisms anymore. It's just the corner that they've painted themselves into. So we're now in what Mr. Dalio and his associates call MP3. And in MP3, we basically have the central banks worldwide, particularly and especially the US Fed, are acting as market makers. You guys, That's not how it's supposed to work. The market is supposed to be the market, right? Maybe we have investment bankers or something like that as market makers. This is unprecedented. MP3 is a big deal. This is not just techno geek talk. What it means is that since the central banks are market makers, nothing old makes sense anymore. I hope that really sinks in and makes sense. You want to talk about price earnings ratios? And if anybody doesn't know, a PE ratio is the price of a stock relative to their actual earnings. And right now, compared to where they have been historically, they're pretty high. And so normally in a typical economy, we would be able to make a decision about, oh, that's too pricey, I'm not going to buy it at that price. But right now, the prices are artificially inflated. And the simplest way to put this is just think about the stimulus checks that people have been getting. What happens when those stimulus checks stop, if they stop? So I referenced this in my Facebook Live video yesterday, but there's something called pandemic put. And if anybody doesn't know, a put is a bet that something is going to keep going up. So right now, the government has taken all this stimulus money. And by the way, yes, they did add this on top of all of our existing debt load that we already had, right? But we already talked about the debt. By putting in all that stimulus money, they're artificially inflating the economy. And can it go on forever? Well, if you know anything about history, let's talk about Weimar Germany. And I know I asked everybody to mute themselves, so I'm not going to ask anybody to answer. But with Weimar Germany, they were just printing money. And what that led to was not inflation, but hyperflation. And after that hyperflation destroyed German society, we did get Nazi Germany as a result of that. Now, we're a long way from hyperflation, but we're trending dangerously towards being like Weimar Germany if we just keep printing money. So there's going to be limits on how much we just keep printing money, and at some point we just won't be able to do it. So all I'm really saying here is we just cannot keep printing money. Or we could, worst case scenario, end up something like Weimar Germany. So going back to our principles here, we talked about the government political issues there. In other words, in the plainest English I possibly could put it, we have an unprecedented level of government interference, not just with tax rates, not just with policies, but with the actual control of the money supply and what that is doing to markets. Again, this is not Chris McFarland's insight or idea. This is from Ray Dalio, one of the 10 richest people on the planet, and he funded and financed his company, Bridgewater Associates, to go and do a 500-year look back. They didn't take 500 years to do it, but they studied the last 500 years. And they found out some pretty alarming trends. And that's what we're going to talk about next. That's the long-term debt cycle. Now, a lot of people aren't even aware of the long-term debt cycle. We usually hear about short-term debt cycles. There was a short-term debt cycle between 1945 with Bretton Woods up to when Nixon took us off the gold reserve in 1972. That was a short-term debt cycle. But the longer-term debt cycle has to do with currency domination. And if we look back very briefly at world history, over the last 500 years, we've had the rise, and not necessarily fall, but decline of a couple different economic empires, starting with the Dutch, and then leading into the British Empire, specifically the economic, not the military colonial empire, for a long, long time, all the way up to the end of World War II, up to what we've been talking about, 1945 with Bretton Woods, where we have the American system, okay? So with the long-term debt cycles, way before the coronavirus, Mr. Dalio was sounding the alarm that the American currency system was being seriously challenged and threatened by up-and-coming economies, most particularly China. But we could also add some other contenders. I saw some interesting information recently about how manufacturing has actually been leaving China. And yes, this is particularly since the COVID crisis, but there's already, even before that, been some migration of manufacturing capacity to Mexico and Vietnam especially, and in cell phone manufacturing to India. But between some of these other rising powers, there is a real threat to the current monetary system and long-term debt cycle. Because another way of saying debt, we can say that equals leverage. And of course, when we use debt in the right way, we can use it effectively to leverage ourselves. But when we get overextended, and I already showed you guys the debt clock, we're going to get to a deleveraging. If I can remember how to spell that. Oops, just got an extra D in there. There we go. I think we have that right now. So in a deleveraging, there are both inflationary and deflationary tendencies. And I direct you guys to some of Ray Dalio's videos to learn about this. But if the government doesn't get those inflationary and deflationary levers just right, then we're going to end up in a situation where we don't get a beautiful deleveraging. And on my Facebook page, there is a link to a 30-minute video called How the Economic Machine Works. And I do highly recommend you guys to check that out to learn a little bit more about the currency wars, how America is being challenged. So just as we do wrap this up, maybe I will just bring up my Facebook page here. Most people who are going to see this are my friends on Facebook. So if you just come to my page, you should be able to find this resource. And just come on here. That's on the home page. And one thing I noticed is a lot of times I look at Facebook just on my phone, but if you're on the computer, I do post a lot of articles here that are relevant to news and economics and stuff with Ray Dalio. But the specific one I wanted to show you guys here is, we'll just go down just a little bit. Here's the one we wanted to look at. This is How the Economic Machine Works, and I'm not going to play this for you right now. But I just want you guys to see that it's animated and very visual, and this is an incredible video that I really, really recommend. Even if you think you know a lot about economics or the economy, this is a great video that anybody could learn from, world leaders, C-level executives, and you. I certainly have. So with that, I'm going to go ahead and invite anybody to unmute at this point, and I am going to actually stop the recording at this point